Let's see what is bond valuation. See, in India, the fixed income bearing securities issued by the government is termed as bonds, and the ones issued by the private sector is termed as debentures. In our class, when I refer to the term bonds, it includes both bonds as well as debentures, the ones issued by the government as well as the corporate bodies. So bonds can be mainly classified into two, government bonds and corporate bonds. So the borrowings of the government is known as government bonds, and these are free from default risk. These are zero risk bearing securities because the bonds carry a promise from the government that the amount borrowed will be returned back to the investor. Since it carries the promise of the government, it is free of default risk. There is no chance of default in payment or there is no chance of bad debts. So these bonds are risk-free bonds. Second category is corporate bonds. These represent the debt obligations of private sector companies. Sorry, there is a spelling mistake. It's debt, D-E-B-T. So these represent the debt obligations of the private sector companies. So those bonds issued by the private sector companies are termed as corporate bonds. There is a possibility of default risk because the happening or non-happening of default risk depends upon the company's ability to earn money. If the company is able to earn money at regular intervals, then they can pay off the debt obligations. If they face with a loss or if there is any shortage in funds, then there is a possibility of default risk. There are two types of bonds, government bonds as well as corporate bonds. Let us look into some of the features of bonds. So the interest rate, the principal amount and the maturity period of a bond is predetermined and fixed at the time of issue itself. So the face value of the bond is known as its principal amount. The regular returns, fixed rate of interest, that is the interest rate or the coupon rate, and the holding period of the bond is known as the maturity period. So there will be no change in the principal, the interest and the maturity period of the bond. The only thing that fluctuates is the market price of the bond. Everything else remains fixed. That is why it is less attractive than share valuation, because for speculators, there is not much scope for making profits out of price differences. Now, a bond has got two features. It has got a callability feature and a convertibility feature, some of the bonds. So there are two types of bonds. There are callable bonds and convertible bonds. What are callable bonds? Callable bonds are the bonds that can be redeemed or it can be paid off before the end of the maturity date. So we do not have to wait till the maturity date to get back the principal amount. It will be redeemed at an earlier date. For example, a bond is being issued for 10 years, but at the end of 5 years, the company has got an option to call that bond. That is, the company has got an option to pay back the investors the bond and settle their accounts. So that is known as callable bonds. The right to call is with the company. The company can decide whether they should pay off these bonds at the end of 5 years or at the end of 10 years. So as far as the investor is concerned, they might be at a disadvantage when the company pays them off after 5 years. If they hold it till the end of the holding period or till the end of 10 years, then maybe the returns they get would be higher. So in order to make the investor happy, in order to make sure that the investor is not discouraged from investing in these bonds, the company will offer high interest rates for these kind of bonds because the investor is at a disadvantage if the company redeems the bonds after a certain period of time. To compensate for that loss, the bonds will carry a higher interest rate in order to attract investors. Now, the second category is convertible bonds. These bonds can be fully converted or partly converted into equity shares at a later date. So the option to convert these bonds into equity shares will be with the investor or the bondholder. The bondholder can decide whether they want to convert the bonds into equity shares after a period of 3 years or 5 years, whichever is a term which was in the agreement. So the company might be at a disadvantage when the investor converts the bonds into equity shares. Therefore, the interest rate that is offered for these bonds are comparatively lesser. So there is a callable bond and a convertible bond. So bond valuation is the calculation of the intrinsic value of the bond and deciding whether we should hold the bond till maturity or sell it off before the end of the holding period. So what are the different types of returns from a bond? The first one is coupon rate. It is a nominal rate of interest fixed and printed on the bond certificate. See, whatever is the interest rate which is offered by the bond at the time of sale is known as its coupon rate. It is calculated on the face value of the bond. We'll denote it as 5% bond, 10% bond. That 5% and 10%, which is the interest rate which will be paid annually at a periodic interval, is known as coupon rate. See, for example, if the coupon rate on a bond of face value of 1000, the value of the bond is 1000 and the interest that is offered is 12%. That is the coupon rate. Therefore, the amount that will be paid annually till maturity date is rupees 120, which is 1000 into 12 by 100. So that is the first type of return from a bond. The second type of return is a current yield. It denotes the annual interest received on a bond to its current market price. See, there will be no change in the interest rate that is being offered by the bond. There will be no change in the face value. What changes is the market price. So what is the interest rate when compared to the current market price? That is the current yield. So current yield is calculated using the formula I divided by P0 into 100. I is the annual interest, P0 is the current market price into 100. For example, a bond which has got a face value of 1000 and a coupon rate of 12% is currently available in the market for rupees 800. So the bond is worth rupees 1000. You will get that at the time of the maturity date. You can buy it in the market for 800 now. What is the current yield? So for a bond that has got a face value of 1000, the coupon rate is always calculated on the face value. So the coupon rate is 12%. The interest that is being offered is 120. That is 1000 into 12 by 100. We are investing not 1000, only 800. So we are getting 120 for an investment of 800. So what is our current yield? For investing 800, we get 120. So 120 by 800 into 100, our current yield is 15%. Even though the bond offers only 12%, at present, because the bond is available at a discount, when I purchase that bond, the return that I get is 15% when I compare with the market price. So that is the current yield. So from this, it is evident that when the bond is selling at a discount, the current yield will be higher than the coupon rate. That is the 15% higher than the 12%. Now suppose a bond with face value of 1000 is selling in the market for 1200 or 1100. In that case, the current yield will be less than the coupon rate. The coupon rate will be higher in that case if it is selling for a premium. If it is selling for a discount, the coupon rate will be less than the current yield. The third type of return from a bond is spot interest rate. See, the return received from a zero coupon bond or a pure discount bond expressed on an annualized basis is the spot interest rate. So what is a zero coupon bond? See, zero coupon bonds are issued at a deep discount. They do not carry interest rate. They will be sold off at a really discounted price and redeemed at the par value. So the investor makes profit from the difference from the purchase price and the redemption price or the sales price. Whatever is the difference value, that is the benefit that is received by the investor. He will not be given interest. So what is spot interest rate? For these zero coupon bonds, we will calculate what is the actual profit that we received at the end of the holding period. That total amount is then is converted into a percentage, yearly percentage. We'll see if we had received interest on a yearly basis, what would have been the rate of return that we have got as interest every year. That is known as the spot interest rate. I'm sure you're a bit confused. Let's look into an example to clarify that point. See, for example, consider a zero coupon bond whose face value is ₹1,000 and maturity period is 5 years. So we have a bond which is worth ₹1,000 and it is to be held for 5 years. If the issue price of the bond is ₹519.37, the spot interest rate should be calculated. So a bond worth 1,000 or bond with a face value of 1,000 is available in the market at 590. That's almost a discount of 50% is being offered for that bond. So you can get that bond for half its price, and during the 5 years that you hold the bond, you will not be paid any interest, but at the end of the 5th year, you will be given back 1,000 rupees. So the difference that you make is the profit that you earn by that investment. So if you convert that income into a percentage which is being earned every year, that is known as a spot interest rate. Let's see how that's done. So if we know the present value and the future value, we can calculate the rate of return or the required rate of return, which is the discount rate, because P is equal to F by 1 plus K the whole raised to N. Now the present value we know it's a 519.37. The future value we know is going to be redeemed for ₹1,000. So we can need to calculate the K value at the end of 5 years, which is the N value. Substituting all that, 1 plus K whole raised to 5 is equal to 1,000 by 519.37, which is 1.9254. 1 plus K is the √5 of 1.9254, which is 1.14. K is 1.14 minus 1, which is 0.14 into 100, which is 14%. So we know that the rate of return that we get per year is 14% when we make an investment in that zero coupon bond. Actually, we are not getting any yearly interest rates in our hand. We will get the whole amount as a lump sum amount at the end of 5 years. But if we are to consider it as annual returns, what is the percentage? That is the spot interest rate. So 14% is the spot interest rate. By making an investment in that particular bond, I will get a 14% return every year for the next 5 years. That is the spot interest rate in this case is 14%. So the cash inflow from the bond when discounted with the spot interest rate becomes equal to the cost of the bond. It's a bit difficult to understand the sentence. We look into an example. See, so 1,000 is the future value. When we divide it with the spot interest rate that we calculated, the required rate of return is 14%. When we calculate it, we'll get the present value at which the security is now available in the market, that is 519.37. So whatever rate of rate of return which makes the present value and the face value meet each other is the spot interest rate. See, the calculation that I show next is not necessary for your examination. I'm just showing the calculation in the hope that you will be able to grasp the concept better, so you can understand the sentence which is given above. See, in the first year, the company owes me 519.37, which is the investment that I made to purchase that bond. And in the first year, the interest, I'm assuming that I'll get an interest of 14%, which is the spot interest rate. So the company owes me 519.37. The company owes me 519.37 plus an interest rate of 14%, which is 72.71. In the second year, see, since I'm not receiving that interest in my hand, I'm assuming that that interest has also been included in the principal amount. I've reinvested that in the bond. That is how I take it. So in the second year, the company owes me 592.08, which is 72.71 plus 519.37. Now the interest will be calculated on that the compound interest will be calculated on that amount. So 14% interest will give you 82.89, and that is added along with the amount that the company already owes me, which is 592.08. So in the third year, what the company owes me is 674.97. Again, a 14% interest is added along with that, and you get 769.46. Again, a 14% interest is accrued to you, which is 107.73 plus the 769.46. So the company now owes you 877.195 during the fifth year. At the end of the fifth year, interest for that amount is calculated at 14%, which is 122.81. So adding both that together, the company will pay you 1000 rupees. So you invested 519, you are receiving 1000 at the end of the fifth year. During those 5 years, interest that is being accrued is at 14%. That interest is being reinvested in the bond, and interest on interest is calculated. So compounding process takes place. So the cash inflows from the bond, when discounted with the spot interest rate, becomes equal to the cost of the bond. That is what I intended to explain through that detailed explanation. So 519.37, it is being calculated with 14% interest, spot interest rate, till it equals the cost of the bond, which is rupees 1000. So that is with regard to the spot interest rate. Now what is yield to maturity? YTM, that is what we need to see. See, it is the internal rate of return earned from holding a bond till maturity. If you're holding a bond without selling it off till the end of the holding period, what is the rate of return that you earn from it? That is known as yield to maturity. So it is a discount rate that makes the present value of cash inflows from the bond equal to the cash outflow for purchasing the bond. Now, let's see, MP is equal to the sum of CT divided by 1 plus YTM plus TV divided by 1 plus YTM, the whole raised to N. So the cash flow from the bond throughout the holding period, that is the C value, that is the coupon rate is what is denoted as C value, and TV is the terminal cash inflow, that's the maturity value at the end of the holding period. Now using that, how will we calculate? For example, consider a bond of face value of rupees 1000 and a coupon rate of 15%. The current market price of the bond is 900. We have to hold it for 5 years to reach maturity, and the bond will be repaid at par value, that is 1000. So we know the current market value, which is 900. The coupon rate is 15, so the annual interest that you receive is 1000 into 15 by 100, which is 150. The TV, terminal value, or the maturity value at which the bond will be redeemed is 1000. We need to calculate the YTM. So what is required is a value of YTM that makes right hand side of the equation equal to 900. So we have to, through trial and error, we have to calculate various percentages till we arrive at a percentage which makes the right hand side equal to 900. So we will start with the assumption of a 20% as the value of the YTM. So if it is YTM, then we can do so by cross multiplication. See, 150 into 1 plus YTM the whole raised to 5 and 1000 into 1 plus YTM the whole raised to T. So first part, rupees 150 into present value annuity factor needs to be calculated for 5 years at 20%. The 20% is our assumption. The 5 years is given in the question as the maturity period. So we have to find the present value annuity factor. That can be determined from the present value annuity table. So this is the present value annuity table. See, the heading is given present value factors for annuity. So such a table is available at the back of your textbook. At the last pages it is given. So go to that. Then you'll be able to see that the number of years is given in the horizontal axis and the rate of interest rate is given in the vertical axis. So What we need is the value during the 5th year. Okay, so we'll calculate this particular column for that. And the rate of interest which we are assuming is 20%. So we will calculate the present value annuity factor of 5 years at 20%. From the table, it is clear that the value is 2.9905. We are going to multiply that with 150. So 150 into present value annuity factor of 5 years at 20%. That is the value that we got here as 2.9906, which is given in the next sentence. See, 150 into 2.9906. So present value annuity factor was taken for that. Now the next part, rupees 1000 into present value factor. So this is a different table, not the annuity table. We have to go to the present value factor table, which is also available in your textbook. So see the heading, it is given as present value factors. So in this table, we have to calculate the value. Here also the number of years is given in the as the headings, and the side the rate of return is given. So we are calculating for 5 years at 20%. So the value is 0.40. See, 1000 into 0.40 is taken here also. So we'll be multiplying those values together and taking the total, and we'll get the answer as 850.49 is the yield to maturity. If you are going to hold that security till maturity, then the yield that you receive is rupees 850.49. So we see that it is less than the market price, which is 900. So we cannot take this percentage. We need a percentage which will make the calculation equal to 900. So we are going to take a lesser interest rate. 20% is seen to be too high, so I'm going to go for a lesser interest rate. We're going to assume 18%. What if the YTM is 18%? Will I get 900 as the answer? See, when I take 900, that also 150 into present value annuity table at for 5 years at 18%. 18% is a new rate. 5 years remains the same. So for 5 years at 18%, the value is 3.12. So that is what is taken here also, 3.12. And the next one is the present value factor is to be multiplied with 1000 for 5 years at 18%. The value is 0.43. So that is what has been shown in the question also. 3.12 plus 1000 into 0.43. Now taking the sum of that, we get the value as 906. So the earlier value was less than 900. The second part, the value was higher than 900. So we are now going to assume that the yield to maturity percentage, that rate is somewhere in between 18 and 20%. So we'll apply an interpolation formula to arrive at an average. So applying the interpolation formula is by the first thing we do is that the lesser value is added, shown as the first value, that is 18. Out of the two values that we took, 18 is the lesser value. So 18 plus 9, the higher value minus the market value. The higher value as calculated is 906.18 minus the market value is 900. Divided by the higher value again, which is 906.18 minus the lower value. That is the value we got when we used 20% as the YTM. That is 850.49 whole into the higher rate minus the lower rate. That is 20 minus 80. This is how it is. So this is the interpolation formula. Now by solving that equation, we'll get 18.22% as the YTM value. Now alternatively, instead of going through this trial and error method, which is very complicated and time consuming, we have got a simple formula which can also be used for calculation of the YTM. So another formula is YTM is equal to I plus MV minus C divided by N divided by MV plus C divided by 2. So I is equal to the annual interest rate. MV is the maturity value at the end of the holding period. C is the cost or the current market price. N is the number of holding years period. So using this formula, by substituting all the values in the question, we know that our interest is 150 plus the maturity value is 1000, the market price is 900, it is held for 5 years. So the numerator part shows 150 plus 1000 minus 900 divided by 5. The denominator part is the maturity value plus the cost or the market value. So 1000 plus 900 divided by 2. So you will get 150 plus 20 divided by 950, which gives you the answer 0.178. That is 17.89% is the YTM value. The required rate of return from that investment is 17.89. So alternatively, we can use this formula also to calculate the YTM. So I hope that is clear. It will be more clear when we work out the example questions in the textbook, which I will explain in the next class. Now the next one is yield to call. See, the bonds have got a callability feature. If I want, I can redeem, that is, the company can redeem the bonds at an earlier date than the maturity date. So what is the required rate of return if we are calling that bond before the maturity date? That is what is calculated in yield to call. So yield to call is that discount rate which makes the present value of cash flows to call equal to the bond's current market price or the cost of purchase of the bond. See, if I see that the yield to call is higher than yield to maturity, then the investor should redeem the bond on the call date. That is, when I see that yield to call rate of return is higher than the yield to maturity return, then it is best to redeem the bond on the call date. Suppose I redeem the bond after 5 years, then I will get a required rate, I will get a rate of return 15%. But when I redeem it after 10 years, at the end of the holding period, I'll get only 12%. In that case, I'm getting a higher rate of return when I'm redeeming it at an earlier date. So the investor will prefer to do so. If the YTM is greater than YTC, that is, if the yield to maturity is higher than the yield to call, it means that I will be getting more profit by holding it till the end of the maturity period. The rate of return that I get will be higher if I hold the bond till the end of the holding period. So I will choose to hold the bond till maturity if the YTM is greater than YTC. So we will calculate both. YTC is also calculated in the same way as YTM is calculated. Then we will compare both the rate of returns and then make a decision whether to redeem the bond or to hold it till maturity. So that is also, yield to call is also a bond return. With that, we come to an end of the different types of returns from a bond. I hope it is clear. Thank you.